Welcome to Luxury Stories, where we delve into the world of high-end living and luxurious experiences. But as much as we love to celebrate the finer things in life, we also recognize that not all aspects of the business and investing world are always above board. That's why today we're sharing with you the top 10 biggest financial scams in history. From fraudulent Ponzi schemes to insider trading scandals, it's important for investors to be aware of the potential risks and to always do their due diligence. Join us as we uncover some of the most shocking financial deceptions the world has ever seen. So, count your pennies and make sure to subscribe to Luxury Stories. Number 10. Enron. The Enron scandal is probably the most famous of Wall Street's financial scandals. Enron was a high-flying energy services company and a darling of the stock market in the late 1990s. When it eventually collapsed, shareholders lost as much as $74 billion. The CEO, Jeff Skilling, and the CFO, Andrew Fastow, used an array of dubious accounting practices to inflate revenue and hide debts. The result was that the company appeared to be the most profitable company in history, when in fact it was saddled with debt. The appearance of a healthy balance sheet and large revenues allowed Enron to easily raise more capital to keep the charade going. Most of the fraud was committed between 1998 and 2001, resulting in the stock price trading as high as $90.56. During this period, CEO Ken Lay gave Skilling more and more authority, which Skilling used to manipulate the company's accounts. The company was able to exaggerate asset values and revenue by changing an accounting policy to use market-to-market prices. These prices were then manipulated. In 2001, the fraud became unsustainable and the company collapsed. Ken Lay, Jeff Skilling, Andrew Fastow, and others were arrested. Fastow and Skilling served 6 and 12 years in prison, respectively. Ken Lay died before he was sentenced. Number 9. Worldcom. During the 1990s, Worldcom was the second largest telecommunications company in the US. However, in 2002, the company collapsed after wide-ranging accounting fraud was uncovered. Telecom companies performed very well during the 1990s as the use of mobile phones grew. When the industry later came under pressure, WorldCom executives turned to cooking the books. They inflated revenue and listed expenses as investments to create the impression that the company was still profitable and growing. When auditors discovered that revenues and profits had been overstated by as much as $7 billion, the stock price quickly collapsed from $60 to $1, and thousands of employees lost their jobs. The company filed for bankruptcy protection and later emerged as MCI, a much smaller restructured company. MCI was later bought by Verizon Communications. In 2006, WorldCom CEO Bernard Ebbers was sentenced to 25 years in prison. Number 8. Mississippi Bubble. One of the first documented financial scandals was the Mississippi Bubble. It was also one of the strangest stories in the history of finance. Investors flocked to buy shares, and Law was able to issue another 300,000 shares. Within months, the share price rose from 500 to 10,000 livres. Law raised so much money that he was able to lend the French government enough money to pay off the national debt. The problem was that so much cash was required for investors to buy the shares that Law's bank had to print more money. Investors trying to sell their shares and then exchange the currency for gold. Number 7. Charles Ponzi's Ponzi scheme. Ponzi had a reputation as a con artist long before the scheme that made him famous. But it's worth mentioning because it was such a big story at the time that certain types of pyramid schemes are now known as Ponzi schemes. In 1919, Ponzi came up with a plan to trade international reply coupons, IRCs. These are coupons that can be exchanged for postage stamps. He believed there was an opportunity to buy discounted IRCs in Europe and then exchange them at face value in the United States. He raised money from investors promising a 100% return within 90 days. The scheme quickly gained traction and he was easily able to raise more capital. At one point, he was attracting as much as $1 million a day. In reality, though, the scheme very quickly became too big to be feasible. But Ponzi found that he could easily pay the promised returns to investors from new investors, and that most reinvested the money in the scheme anyway. But the scheme collapsed within a year when a series of articles in the Boston Post caused investors to demand their money back. Ponzi ended up serving time in prison, but amazingly launched another scam as soon as he was released. Ponzi schemes and pyramid schemes are illegal in most countries. Number 6. Bernie Madoff. In 2008, Bernie Madoff's hedge fund empire was exposed to be another Wall Street fraud and the largest Ponzi scheme in history. This story is also unique in that it wasn't ordinary people, but wealthy investors and fund managers that were fooled and suffered losses. Madoff posted impressive but fictitious returns for his hedge funds. Supposedly, he was investing in blue-chip shares and then engaging in portfolio hedging by buying options on the S&P 500. Madoff's own sons reported him to the SEC. In total, investors lost $64 billion, though the money never really existed in the first place. Number 5. The 2008 Global Financial Crisis. The GFC of 2008 is typically regarded as an economic crisis and not counted amongst financial scandals. However, amongst the many causes of the crisis is a long list of unethical behavior, conflicts of interest, and corporate fraud. For a start, rating agencies were paid by issuers to give very risky securities investment-grade credit ratings. Banks sold securities to investors that they knew to be incredibly risky. Banks also created synthetic products to help hedge funds bet against the mortgage market. One of the big catalysts for the crisis was Lehman Brothers, which filed for bankruptcy when it could not be bailed out. Number 4. Wirecard. Wirecard was a company that processed payments on behalf of merchants. In certain countries, Wirecard used subsidiary companies to process these payments on its behalf. At some point, the company began reporting fictitious revenue from these subsidiaries, which eventually accounted for the bulk of Wirecard's profits. When the media and several whistleblowers alleged the revenue did not exist, Wirecard accused them of trying to manipulate the share price for short sellers. They even sued the Financial Times, which resulted in German regulators investigating the journalists rather than the company. It ultimately transpired that around $2 billion in liquid assets simply didn't exist. Within days, the share price collapsed from €100 to zero. Wirecard, which was worth $28 billion at one point, is now insolvent. Number 3. 1MDB. One of the biggest financial scandals in Asia began in 2009 and is still being unraveled. The story of One Malaysia Development Berhad, 1MDB, involves Malaysia's Prime Minister at the time, Goldman Sachs, and a blockbuster movie starring Leonardo DiCaprio. Joe Low, a young financier who masterminded the fraud, is now an international fugitive. In 2009, Malaysia's Prime Minister, Najib Razak, launched 1MDB as a strategic development company, which was owned by the Malaysian government. Amongst the investments was the company that produced the hit movie Wolf of Wall Street. In 2012 and 2013, Goldman Sachs helped 1MDB raise $6.5 billion by selling bonds. It has since emerged that as much as $4.5 billion were embezzled by key officials. Number 2. Theranos. Initially heralded as an innovative healthcare technology company, Theranos opened for business in 2003 with 19-year-old founder Elizabeth Holmes at the helm and a commitment to making the common blood test more efficient, more accurate, and much faster. Flush with $700 million in equity investments, Theranos was valued at $10 billion by 2014. By 2015, however, the company's highly touted automated compact testing device was exposed as unworkable by medical testing professionals. Soon after, federal and state regulators filed fraud charges against the company. Crushed under the weight of legal costs, Theranos dissolved in 2018. Court battles ensued, and in November and December 2022, Holmes and the company's former president Ramesh Sunny Balwani were both found guilty and sentenced to more than 11 and 12 years in prison, respectively. Number 1. FTX. FTX launched as a trading platform for crypto investors in May 2019, with Bankman-Fried as its majority owner. Known universally now as SBF, Bankman-Fried had previously opened a hedge fund with a friend, Gary Wang, called Alameda Research, LLC. In late 2022, the U.S. Securities and Exchange Commission accused SBF of defrauding his company's investors by steering money from FTX into Alameda Research between 2019 and 2022. SBF and company executives allegedly used the cash to purchase homes in the Bahamas, invest in other companies, and fund favorable favoured political causes. When crypto assets took a precipitous plunge in 2022, the cash spigot went dry at both FTX and Alameda, with the latter owing FTX customers about $8 billion according to the Commodity Futures Trading Commission, and federal prosecutors stepped in to issue fraud charges. By November, FTX and Alameda went bankrupt, and SBF was arrested on December the 12th in the Bahamas. And that's it for today's video. We hope you enjoyed watching. And if you're interested in more luxury stories, make sure to also watch The 10 Richest Criminals That Never Got Caught. See you in the next one.